Hey, everybody, it's Ken, and I'm here with George Gammon. What's happening, George?
Good to be here,
Good
buddy.
seeing you, man. So if you guys don't know George, you're under a rock. George has got an incredible YouTube channel. He's my partner in the collective. We're doing an event in 2 weeks in Scottsdale. We're doing another incredible...
Limitless, baby.
Limitless.
I'm speaking. It's going to be awesome.
Yep, and we got a whole range of speakers there. And then I'm going to be speaking at his event along with Kiyosaki and a bunch of other people at the end of the month at Rebel Capitalist, right?
Yeah, Rebel Capitalist Live,
Yep.
Miami, June 24th through the 26th.
Yep. So let's jump right in on interest rates. Everybody knows we've had these high inflationary months, and I don't know where it's all heading, but interest rates have gone up at least twice, 3/4 of a point so far. Where do you see all this heading?
So we could look at Fed funds. What is the Fed going to do? But that's a little bit different than mortgage rates, as an example, because what we saw while the Fed was doing quantitative easing is they were buying a lot of those mortgage-backed securities. So the Bank of America, let's say, when they go down and give you your home loan for $500,000, they're selling that paper to Fannie and Freddie before the ink's dry. But then that goes out into the private sector. When the Fed buys these, they buy at any price. They don't care if they lose money. They can literally print the money. So they'll buy at any interest rate, any price. So they don't really care about future inflation expectations, nor do they care about a risk premium that would usually be associated with that mortgage if it's absorbed by the private sector, because they have a P&L, right? So we saw the Fed do QE from, let's call it 2008. They had a little bit of a lag or a time delay with QT before the market had a tizzy fit. And then we went into 2020 where we had the COVID, where they did QE infinity and their balance sheet just completely exploded. So they're buying $40 billion a month roughly of mortgage-backed securities. But what happened in November of 2021 is they declared that they were going to gradually reduce that QE program down to zero and then actually start QT. So this is quantitative tightening, where instead of buying mortgage-backed securities, now they're selling them into the market. So what I find interesting is if you look at a chart of the 30-year fixed-rate mortgage and you look at a chart of Fed funds, it is true that Jerome Powell's taken the Fed funds rate to 75 basis points, 1%, but mortgage rates have gone up way higher than that. They've gone up much higher than just 1%, roughly from, let's call it 3% up to 5.2 or wherever we are today. So why is that? Because if the Fed isn't buying those mortgage-backed securities and they're being absorbed by the private sector, now all of a sudden there needs to be a risk premium on that interest rate, or the price they pay is lower. So you get the mortgage rates, if the Fed's absorbing all of them, at 3%, but if the market's absorbing them, well, now all of a sudden they're at 5 or 5.2. So then the question becomes, okay, what do mortgage rates do if the Fed starts selling mortgage-backed securities? Because now they're adding supply, they're reducing demand. And as you know, that usually means the price goes down. And there's an inverse relationship between the price and the interest rate. So interest rates go up even higher than they already are. So I think we could go into an environment where the Fed is only maybe raising rates another 25, 50 basis points, but mortgage rates go up another 2, 3, 4%. And I don't know how that affects, well, we talked about demand destruction, and that would definitely equal a lot of demand destruction for homes, because mortgage rates would go to a point where the people just could not afford the monthly payment for the home they want to purchase. And we were just talking about the supply side of the equation being at historic lows, and that is absolutely true. But as far as residential homes, these starter homes or pretty much any residential homes, I should just throw them all into a bucket, we could see an environment where aggregate demand goes down to a point because mortgage rates go so high that it actually starts affecting the nominal price of the real estate market in aggregate total, even though the supply is at all-time lows and probably isn't going to get better anytime soon, unless we have, I think the only release valve there would be these big funds like Blackstone having a better risk reward alternative to those single family homes that are on their balance sheet. So they sell those and buy, let's say, a 10-year treasury if it's at 6 or 7%. I think that's the only way that we're going to get more supply coming online quickly. So then it's just a question of how much demand destruction is there, as if these mortgage rates skyrocket even higher than they already have if the Fed does quantitative tightening like they've said they're going to start in June.
What are some of the consumer behaviors and some of the things that people are going to see when this recession hits? Because I believe it is going to hit.
So I think that people can expect to see higher rates of unemployment. You see economic output go down, and you see the standard of living go down. You see people's purchasing power decrease. And a lot of people associate that with deflation. But we can absolutely have an inflationary recession. So that's really the bottom line. It's just a lower standard of living, especially and unfortunately for the poor and the middle class, because like we said earlier, prices always go up at a much faster rate than incomes. So their purchasing power really gets squeezed. And usually the things that are going up in price are the things that occupy a larger percentage of their paycheck. We've consumed in the United States far more than we have produced. And we have lived off of asset prices and artificially low interest rates for a long, long time. And we've lived off our 401k, and we've lived off our home equity. And at some point in time, you got to pay the fiddler.
So what do you see outside of the U.S. from a supply standpoint?
When people think about these supply chains and the supply chain disruptions, you have to understand how fragile they are and how intricate they are. And this goes back to the 1940s, and why I don't know that we can simply just cure high prices with high prices, because I don't think that we can fix those supply chains as quickly as we otherwise would, because the world is much, much different, and so is consumer behavior.
Well, George, as always, brother, thank you.
Thanks for having me on,
man.
man.
Time, man.